Hello, my name is William. I work in corporate finance at Équipe J.
So when you're ready, you can start.
Bonjour mesdames et messieurs, membres du comité exécutif. Je me nomme Théo et je suis aujourd'hui avec mes collègues Jing Hong et Raphaël pour vous présenter la solution que nous pensons optimale pour le groupe Bétonec. Notre présentation se déroulera en anglais et ça nous fera grand plaisir de répondre aux questions en français ou en anglais. Et ne vous inquiétez pas, je me chargerai de garder mon accent français tout au long de la présentation.
Thanks, Theo. Now, everywhere we go, we can see that even the very floor that we're sitting on, concrete is at the basis of all construction developments. Bétonec has been a key player in Quebec since 1968. Now, what has led this company to become such a successful story and propelling it to 2020? We believe this is based on two main pillars. Your strong family values, as well as retaining excellent product materials delivering to your consumers. We here at RGT & Co. are proud to propose a solution that will answer to both of these pillars of family ownership, as well as providing great materials to your customers. Now let's dive into our executive summary over here. We're going to be looking at a brief analysis of the company, where it fits into the market today, as well as going into more detail on our evaluation, our recommendation, as well as, our implementation, as well as our recommendation for the company. Now, what is our specific mandate and solution to all these problems that we've highlighted? Well, the first thing is, if you want to propel the company into the future, you have to make sure that one of the main ways of growth for the company is either through organic growth or acquiring companies. So this leads to our main first question was, should we acquire BDN, which is a main competitor in the Quebec market space? Now, we believe that the solution will be yes, and we'll go into greater detail as to why we think so. Second point is the main point of a succession plan that is in place for Bétonec. As you can see that there's tight ownership, and some of the shareholders in the company might actually want to give up their ownership, so we need to address this key issue. So we believe that Luc will be a key component here to solving this problem. And the third is there's an increased amount of environmental regulations, and we'll see that by revamping 3 of your old power plants, you'll be able to satisfy this key environmental requirement. Now, what's in it for you? We think that this is answered through 3 ways. Operationally, you'll be able to increase your pricing power and reducing your cost. Financially, you'll be able to fund the acquisition by a mixture of 50% debt and 50% issuance of equity. And finally, it's a strategic standpoint as well, by consolidating ownership within the family and bringing in a strategic partner, which we'll highlight later on. Now, to go into the analysis, Jing Hong will lead us there.
So let's take a look at the current market. The concrete industry has been declining at 1% year over year due to increased pricing requirements. So this industry competes a lot on price, and we see that there's a lot of competition within this market. Now, the main industry drivers are economies of scale, sustainable production, as well as growing demand for the next 5 to 10 years. So something I want to point out is that 2019 has been the warmest year across globally, which means that companies face greater pressure to find sustainable ways of manufacturing products. So since we have limited pricing power, our key advantage would be to reduce costs, which means economies of scale. And we want to think this concept throughout our entire presentation of how we're going to achieve economies of scale. Next, taking a look at your company. Your revenue has been increasing at 5%, which is beating the market. However, your net income has increased at even more impressive rates of 10%. So right now we see that you're in a very good position. However, we want to question whether or not the margins are sustainable, because we noticed that over the past year, your increasing margin has been primarily driven by the decrease in commodity inputs. And we know that commodity prices are volatile. So we want to think about a way to achieve sustainable long-term growth. And how are we going to do that? So before we answer that question, we'll also want to take a look at your current company structure. We understand that George wants to retire, and he's wondering who's going to be the next leader of this company. Currently, we identified 2, Edgar and Luc. Luc now has a lot of capital that can allow him to acquire greater ownership of the company, and at the same time, Edgar has the capabilities to drive the company forward. So how exactly are we going to achieve that competitive advantage of economies of scale? Now, we're going to take your company to the next level by acquiring Béton du Nord. So let's think about why this company, and secondly, what it means for you. So Mr. Lesage is retiring and he does not have any successors. Also, the fact that you guys are a competitor means that you will be a strategic acquisition that can allow you to achieve synergies. In terms of what it means for you, you'll be able to increase margin on both increasing pricing power. As you get bigger, you can negotiate better prices, and secondly, to reduce costs. So we believe that the acquisition of BDN will allow your company to reduce your supplier and customer bargaining power, ultimately driving your future growth.
Now this clearly highlights two main problems here. Obviously, the one is pertaining to the succession plan. So we've highlighted that some grandchildren actually want to sell their ownership stake in the company, around 5% of their ownership, and be transferred to somebody else in the company. So this is a clear issue with succession and split ownership within the company. And the second thing as well is the competitive reasoning behind acquiring the company. Is how would you be able to remain profitable with, in an industry where it's very tight margins in terms of the EBIT margins. So we see that a viable solution here would be to acquire another company to be able to lock in better economies of scale as well as increase your revenue synergies. Now this leads us to answering these two main problems with our three-pronged strategy. This is by doing so, to be able to answer this is acquiring Bétons Nord as our first point. The second point is also to transfer the ownership of the grandchildren over to Le Tremblay. And the third one is renovating the manufacturing plants, as we have mentioned before.
Now, to answer the first question, why do we want to acquire the Tremblay? We can either acquire as a whole business or just the assets. Now, the other alternative is to grow organically. So in order to answer this question, we want to think about what it means for your ownership, what it means for your costs and your pricing power, and also whether or not it's the right timing, and finally, whether it's in the interest of the company that you're trying to acquire. So organic growth, as we want to eliminate right away because it will not allow you to increase your long-term competitive advantage. Between acquiring the company as a whole or just the main assets, we also want to satisfy the desire of the seller. And because we know the seller wants to sell the entire company, we believe that this is the more optimal solution. To answer the second question.
To answer the point about the succession plan, as we mentioned, there's three main grandchildren that have 5% ownership that do want to use this capital to attain their other personal goals. Now we think that Le Tremblay should, in our calculations, buy in total 5.5% of the share of all three of these grandchildren for a maximum amount of 400,000, which is the amount that Luc is able to spend on the actual acquisition of these shares. Now by doing so, it would allow Luc Tremblay to own 60% ownership into the company. The reason why we think that Luc should be the one to acquire this specific amount is because Luc has already proven himself as a very strong manager for the company over the past years. But we also believe that Agar is still a bit in his early stages to be able to succeed into the company. So we believe that Le Tremblay, which is the uncle of Agar, he will be able to assess if Agar's growth is an actual positive virtue into the years. And then into the future, he'll be able to then transfer the ownership over to Agar. So we want to make sure that we don't skip the generations here. So George was the first owner of the company. We think that Luc Tremblay is already having a very success story right now. And we think that the third generation will be passed on to Agar. But for the time being, we think that Luc Tremblay should be the one to have the ownership. Now, to our third point is that there's very strong environmental regulations that will be put in place. And we've highlighted that by acquiring the Bétons Nord, there are three main power plants that will need specific renovations. Saint-Jérôme is the one that is owned by Bétons Nord that has a year in construction in 1998. Préau and Laurentien are owned by Bétonic already to begin with. And we believe that on a capacity basis, the total cost to renovate all three of these plants will be 350,000 for the first, Saint-Jérôme, Prévost at 280, and Laurentien at 420. And all in total, what this will mean for Bétonic is that not only are you renovating one plant, but all three that will be able to satisfy your environmental requirements that will be coming in 2025. Now, in terms of the valuation for the actual acquisition of Bétons Nord, we have to be able to assess in our methodology three main points here. The standalone valuation of Bétonic, your company, the also standalone valuation of Bétons Nord, as well as what's the actual combination value of both companies combined together in terms of synergies. So I'll pass it out over to Theo to go into the
So let's work through the number. Let's start with Le Béton du Nord on a standalone basis. We want to first take a look at the top line growth and the profile for the next 5 years for the company itself. We see that the total revenue of the company will grow at a certain rate between 1.6 to 3%. Such a rate is very stagnant due to the current competitive pressures and due to the current competitive environment in which the company is evolving. We also see that when we look at the bottom line, the net income per se, the margins are pretty low and pretty steadily low over the years as well. Again, this is assuming that the current landscape, the competitive landscape, will not change. Now, what does that mean for the cash flow profile of the company? Well, a couple of things we can see. First of all, we see that the depreciation and amortization is a very important component that's actually increasing the free cash flow to firm, so the unlevered free cash flows. The reason for this is that there's a lot of investment, CapEx investment has been made before. There's a great balance in terms of property, plant, and equipment, and there's a lack of investment in the last couple of years, which is translated by a low maintenance CapEx. However, this depreciation on the value of the current assets is still here. So this is why we have a free cash flow to firm that's actually high. Now, when we look at the valuation of the company itself, we see again that the argument of the company having made a lot of investments before is also perceivable in the debt aspect here. The company is running low on cash, reinvesting its cash using its cash to cover the capex, the capex itself. While the debt amount is already is pretty expensive. So that leads us to an implied equity value of $2.3 million and an implied enterprise value of $2.7 million. This is a little bit on the lower end than what the current owner of Le Béton du Nord was expecting. However, we'll see in the transaction slide that we'll implement a premium on the acquisition of Le Béton du Nord to reach this requirement that the current owner expects. Now, this sensitivity analysis is really to show a little bit how, under different scenarios, under different economic scenarios, the value of the company would move. We see that there's a range that could go to from about $2.5 million to almost $3 million without any premium added. This is the equity value of the company, so the enterprise value would be higher on this. Now, we also wanted to consider the growth profile of Bétonec by itself, because it would make sense to go forward with the acquisition if the resulting value is higher than the standalone value of Bétonec. So we see a pretty similar revenue growth profile. It makes sense. Both companies are operating on the exact same market, and we also see a pretty similar margin profile actually. Now, in terms of the cash flow profile, again, they have a similar business model. They are renowned as very close competitors, so we see pretty much the same pattern here with the high D&A, the lower capex, which is a maintenance capex, and that drives the free cash flow to firm. Now, in terms of the valuation of the group Bétonec, on a standalone basis, we believe that the value of the company could go to a maximum of $6.5 million with our current projections. And now let's take a look at the financing before we actually work through. Sorry about that. So let's take a look at the valuation of the combined company before actually looking at the transaction itself. So in terms of the combined company, we worked through an M&A model, assuming a couple of revenue synergies, assuming a couple of cost synergies. It makes sense. If the players in the company, in the industry, are merging, if there's some sort of consolidation, there's higher pricing power for the company. And we also think that due to scale, a couple of costs, namely the delivery costs and also the cost of raw material, some synergies there could be achieved as well due to a higher amount of orders and in terms of delivery due to a more efficient distribution channel. With that in mind, we came up with this free cash flow schedule. and which led to this valuation. So we have an implied equity value of $6.8 million and an implied enterprise value of $9.5 million. This is significantly higher than the standalone standalone valuation of Groupe Bétonnec. And this is why we think that we should go with this merger, due to the higher valuation that comes from the revenue synergies and the cost synergies that we think are going to be achievable in a market that will be more consolidated and where you will be the major player. Now, coming back to the financing of this transaction, Ralph will take you through this.
Yeah, great, thank you, Theo. Now, if we go actually to the unaffected share price of Bétonnec, we can see that it was offered around $23 a share. But by instituting a premium of 32% at around $30 a share, we can see that we can satisfy the purchase equity value of $3 million here that Monsieur Lesage, the current owner of Bétonnec, really requires to be able to sell the company. Now, taking this into account, we realize that the best way to finance this purchase equity value of $3 million is done through an issuance of stock at 50% and another debt issuance at 50%. On the debt issuance, we already had a contract in place that was around $1.5 million that could already cover 50%. Now, this leads us to a question: where are we going to get the equity portion of 50%? We could choose either a venture capital firm that would require at first debt, which then into the future would be convertible into equity around 25%. But we thought that we could actually do something better. We thought that we could recommend you to go with a strategic partner such as either PSP or even La Caisse de Dépôt that have a very strong private equity brand that are very active into investing into these small private companies, and they would actually take a part into the company. Now, you might wonder what would this have as an impact for the ownership of the company, bearing that it's a family-owned company. Like we had mentioned here, the actual implied equity value is at 6.8. If they come in at 50% of the purchase equity, they would have around 25%, which is very comparable to what the venture capital firm was requiring. Now, we believe that the venture capital firm would have much more aggressive targets and would pressure a lot more the board than would CDPQ, that has a more lasting vision for the Quebec economy and is much less aggressive, which is more in line with the ideals of the company. Now, in terms of the implementation, there's several steps here to take into consideration. Now, obviously, the acquisition of Etienne, we think that would start this year and would pretty much end by the end of this year as a fairly small company, and they're both two private companies. The transfer of ownership from the three grandchildren over to Luc thinks that this can be done within 1.5 years, as we believe that there's several conversations that would need to be done within the family members, that they would all need to agree and make sure that the transfer of ownership is following the values of Georges, but also Luc and Agar and all of these combined. As well as we are not super certain as where one of the grandchildren is at the present moment, as he's traveling around the world doing a bunch of concert tours and music tours. So we're a bit more conservative here by giving at least a year and a half. Now, bringing the strategic partner would be directly in line with acquiring BTN. The strategic partner line I mentioned is La Caisse de Dépôt, or PSP. And then the two main points here to highlight as to why depreciation was such a big point in CapEx as well for the valuation of the companies resides with the renovation of power plants and renewing the fleet of trucks. These are extremely important measures that cannot be overlooked. The first point here is to renovate the power plants that we believe will start in 2021 all the way to 2025 to meet the regulations. These are very, like we had mentioned, it's very adamant for them to do so, to be able to satisfy the economic and environmental regulations, as well as renewing the fleet of trucks, as it is a reality that a lot of these trucks are aging. They have a depreciation of around 15 years, and the current average right now is, well, actually, the trucks are projected to be fully depreciated by 2023, so we believe that we'll increase the CapEx at that moment until 2025.
So we do recognize that this project comes with risks, but we do have mitigations. There's a threat of new entry nearby, but by acquiring the other company, you can increase your pricing power as well as reduce your costs and allow you therefore to maintain a competitive pricing. Secondly, there's volatility of the commodity of the price, but then again, because you're growing bigger, there's greater negotiation power. And finally, there might be shareholder conflict, but we can resolve that by adjusting the needs of each of your current owners and seeing where they would like to go in the future. There are at the same time a lot of catalysts that will drive your company forward, including increased margins, the increasing demand of projects, for the next 5 to 10 years. And finally, because you're renovating your plant, you can achieve, you will project a very good brand image. So we thank you for this presentation and welcome any questions.
Thank you.
I have a question. You talked about volatility for the input prices. You mentioned the fact that because you're bigger, you're going to have more negotiating power. Do you have any other suggestion how to hedge your risk?
Yes, you can think about commodity futures. So when you get a commodity future, you're locking in the future pricing, and that will allow you to have greater certainty as to what your input costs will be. And then that way you will have more flexibility to think about your SG&A, your marketing costs, to think about what is the optimal cost structure that will allow you to still pursue the same returns.
Good, thanks.
I have a question. In both the valuation for Betonek and BDM, the depreciation expense was way higher than the capex investment, and this at perpetuity also. So, is there not a disconnect in between the two? At perpetuity, having more depreciation than capex.
So from yes, we do realize that this was the discontinuity. However, we believe that we penalized the company. So how can I say that? The capex is basically going to reduce the amount of unlevered free cash flow. And since we didn't take that into account in the very first, in the calculation of the unlevered free cash flow, we realized this later on and tried to implement this this discount basically in another aspect of the valuation. So that's why we came up with a WACC, and especially on the premium from the WACC. This is not industry standard, but we believe that the discount we used in the WACC, and so in the discount rate, thus driving down the value of the company, reflects the value that the company would actually have.
We do need to mention that the standalone basis for both of these companies, we're assuming a maintenance capex, whereas the combined companies actually induces also the growth capex, as we had mentioned, for the renovation of the fleet. And in that scenario, then the capex is higher than the depreciation, resulting in the result that you're expecting.
You mentioned 32% premium on the price per share for Méthodes Nord. Why would I pay 32% premium?
So we realized that through our model, we realized that having a combined entity would be much more beneficial than growing on a standalone basis. Now we also realized that the seller has a couple of requirements, and his major requirements was to sell his company for at least $3 million. So knowing that and knowing the current situation of the market, we realized that it would be beneficial actually for the company, which is the Group Betonek. It would be beneficial for them to pay that premium and take the extra cash. I mean, pay this extra cash to actually have more value in the future.
You mentioned that Luc Tremblay should buy 5.5% for $400,000, which gives a valuation of approximately $7.2 million. So my question is, should he buy the shares before the acquisition or after? And at that valuation, do you think it's fair?
So we actually consider this, and we think that we always need to be able to make sure that we reflect the true family values of Betonek. And we thought that if you transfer the ownership of the shares before the acquisition as a standalone basis, it would be unfair for the shareholders as the combined entity, so the post-merger company would have more value. So we think that by selling the shares after that, the grandchildren actually reap the benefit of selling their shares with the synergies implied, rather than just the uncle buying the shares before the merger happens, then he's reaping all the synergy benefits while leaving the grandchildren behind. We think that didn't reflect the family values as well.
Could you just comment on the fact that you use the same weighted average cost of capital for both Betonek and Méthodes Nord?
So there's actually, we made an adjustment to this. We did not end up using the same cost of capital for the reason that Betonek is still a bigger company than Les Bétons du Nord. So we realized that due to the scale of the company, the risk linked to this company is lower, and we ended up with a difference in discount rate of about a little bit more than 1%.
Do you believe that going with equity financing could impact the timing of doing the acquisition? Because you said 1.5 years, is it going to still be a good time to invest, given the recession is maybe coming, we don't know?
Right. There's two main points here. We need to look at it from CDP3's perspective, as they would be buying into the company. Since we see that for one, it's a private company, and the actual equity investment is $1.5 million. So we were very conservative by saying at least 1 to 1.5 years. We think that this could be done probably within 6 months, as the two players are drastically different size.
Unfortunately, I gotta stop you because you passed your 5 minutes.
Oh,
Sorry.
Thank you.
Sorry.